Vaibhav, Sanghavi CEO, Ask Hedge Solutions, also joins us to have a discussion in terms of what's happening with the markets right now. Vaibhav, welcome to the show. Always a pleasure to speak to you. You know, before we talk something broad-based, let's pick it up from an IndusInd Bank, from where Somit left it. And let's look at the entire space. You had a HDFC Bank as well. You have ICICI Bank, which has outperformed versus what the others have done in the private banking space. What is your view in terms of the private banks' earnings so far versus whatever the PSU banks have reported? I know SBI is yet to come, but how are you looking at the setup there?
Thank you very much for having me on the show. And, with respect to your question in terms of the private banks, let's take a step back and see for the last 2 months when, from the steps which the government had taken in terms of the FCNR, ECB, and the GSEC reforms. I think we had a very positive sentiment around the overall private banks. In addition to that, if we see the pre-quarterly updates, I think those were factored in pretty much well by the street in assumption that the performance has kind of started to improve. The only disappointment which we've seen in some of those banks is basically the pressure or larger pressure than expected in terms of the net interest margins. While the other parameters continue to be stable and doing well, I think Street somehow has got a little bit disappointed on that. And to add to it is basically the Middle East concerns which are coming about in terms of the oil prices back again, which is kind of getting into an environment where it is slightly risk off, and because of which we are seeing some amount of pressure on all those names as well.
Vaibhav, hi, morning, Alex here. So I just want to take that forward. So pressure on NIMs in the first quarter, okay, understandable. A couple have actually performed better than anticipated, and I guess those are the ones that are getting rewarded. But going forward as well, even if I look at an IndusInd Bank, if I look at an Axis Bank, if I look at maybe even a Kotak to a certain extent, the corporate lending has gone up, and that's understandable because from the perspective or the lens of the corporate, if they're looking at the bond market where they were raising funds, yields have gone up. So comparatively, bank funding is cheaper. And so we could well see that continue through FY27. So the point is that you could see further erosion in NIMs going forward, Vaibhav. So how does that change your view on the space?
See, of course, the street is starting to discount some of it for sure, but I would only refrain from coming at that conclusion at this point in time. The reason being that most of the private banks would be the beneficiaries of the FCNR deposits as well. So what not only that will probably improve their credit deposit ratio, but at the same time would be marginal cheaper in terms of the cost of borrowing. Now, also, those amount of deposits will be between 3 to 5 years, which is pretty steady and long-term money as well. So maybe I think I will just refrain from that view, at least for a quarter for now, and then probably will round up, post the next quarter results to see where we are. So let's wait and watch. I think this pressure, in our view, is a little transitory. I think it will start recovering from a quarter, after this.
Vaibhav, overall, if you have to look at what's happening in the markets, do you think that the story or the narrative for the Indian markets is actually shifting from a capex-driven narrative to a consumption-driven narrative, and that's what the street is watching out for?
See, I think in the shorter term or extremely shorter term, I think depending upon the price movement and the valuations, somewhere you may see those kind of rotation probably happening. But when you look at from a medium to longer term perspective, I think manufacturing as a theme is likely to continue to do well over the next 3 to 5 years. Looking at what the government has been in terms of supporting the whole sector, in terms of various reforms and measures, my sense is basically one should definitely look at the whole industrial space or capex driven themes at every declines. So I'm not saying that it may not probably correct in a very shorter term and depending upon the overall market sentiment, but from a medium term to longer term perspective, I think the story is extremely robust, and we are quite bullish on the overall theme from a longer term standpoint.
It's a pretty wide space though, Vaibhav. And others before you have highlighted that those manufacturers that are also focused on expanding their global or export footprint should be preferred. But how do you slice this space, and where does your preference lie?
So, Alex, I think very interesting question. I think two parts to it. One, of course, as you mentioned, the exports, as a theme for sure. But at the same time, also what we are also looking for from a perspective of a supply chain in the data center theme. We all know that the data centers, which are currently close to about 1.5, 1.7 gigawatts, is likely to go more than 10 gigawatts within 4 to 5 years. And that is the kind of capex which is likely to happen, which is anywhere between 80 to 90 billion dollars. Then my sense is the whole supply chain within that, including switch gears, electrical equipments, probably diesel gensets, utilities, chillers, the whole space of that industrials is likely to do well, in the medium term. So, yes, exports is a theme, but accompanied by all of these, including the transformers, and is something which we really like from a manufacturing standpoint.
Weber, you're talking about the positivity that you have, the segments, which you're betting big on. However, if you have to look at the next 2 years, would you choose between earnings growth or valuation re-rating? What would be the key drivers to get returns in the next 2 years?
So in our view, earnings growth is paramount. And when you see earnings growth, then valuation re-rating kind of follows in some sense. So we will be focused on the earnings growth, which are the companies or sectors which are likely to deliver that, along with the overall sectoral tailwinds as well. So that would be our focus for the next 2 years at least.
So let me ask you this. If you were to, at this moment, construct a portfolio, Vaibhav, or adjust the weights in your portfolio, what is the kind of weightage that you would give to each of the things that we've spoken about so far? So we've discussed financials, we've discussed industrials, we've discussed consumption as well. So, and then let's throw in maybe an IT, which has been something that everybody's been confused about for good reason. And some people have gone so far as to say that they will reduce their weight to practically zero. So how do you look at weightage as things stand right now?
See, Alex, I think we are, from our perspective, we are a long short fund, right? And we have the liberty of choosing the sectors both ways in some sense. So when we talk about our outperformers sectors, as you rightly mentioned, financials definitely will occupy some amount of space. Honestly, we were not very keen a couple of months back, but what the government has done in terms of those measures, my sense is once the Middle East situation kind of solves a little bit, then you will see financials, a lot of interest coming back into the financials. So we are keen, and fundamentally we do like that space. In addition to the industrials theme, which we mentioned, lastly, I think the CDMO space is something we additionally like from an overall medium to longer term perspective. While on the negative side, I think what we are avoiding currently very clearly is the global commodity space, which is metals, and to some extent, IT space as well. Lastly, we are on watch out for consumers, especially to frame a very concrete view, depending upon how the progress on monsoons is happening in the light of El Nino as well. So that is something which is on a wait and watch mode, but otherwise, I think that would be broadly a construction of our portfolios.
Okay. Vaibhav, you mentioned about industrials as well. How big a portion of that is the data center, ancillary part of it playing out, because you're talking about cooling equipments, transformers, utilities. Is that a space that you're going big on? And two, pharma as a sector, because you've already spoken about tariffs, but no one really knows whether that is going to have a material impact. And you have been fairly positive when it comes to the CDMO space. Does anything change on that front?
No, of course. Taking the second question first, I think the CDMO space, I think we are more enthused from the medium to longer term kind of opportunity in the wake of Biosecure Act. And you are seeing, on ground incremental RFQs kind of on a continuous basis kind of coming about. So we do like that space. The companies are doing capex, are only reflecting the confidence of the upcoming growth, coming within them. So that's something which we like. And when we talk about the industrials and the data center theme, I think a large part of my industrial exposures is within this data center theme, right from switch gear equipment, electrical equipments, diesel gensets, utilities, and so on and so forth. While we always keep on looking at the right time of entry within these sub themes, but overall, I think we are fairly positive on the overall fundamentals.
Okay. How much of your view, Vaibhav, will change based on macro at this moment? And I know that for a bottom-up stock investor, peripheral knowledge of macro, and some people even scoff at it. How much are you talking about macro? But let's face it, ultimately, if crude oil is at $95 to the barrel, that is ultimately going to bleed through into inflation, and then consumption has a bearing on consumption. So how much of your direction or your decision making will depend on macro?
Of course, I think a lot of importance is something which we give or weightage we will give to the overall macros as well. Now, over the last 2 years, in some way and fashion, while the companies have continued to deliver, because of what's happening from a macro standpoint, especially from the geopolitical standpoint, we've not seen much of interest coming to India as compared to the other global economies, especially on the AI team. So what we do focus heavily is on the relative positioning of India within the global markets and especially within the emerging markets. And that is how we do take a call on our active long and short or our net exposures on an overall basis. So yes, that forms a very critical and an important part of our portfolio decision-making approach.
So macro is also a key component that one should be watching out for. But thank you, Vaibhav, so much for joining in. It's always a pleasure to speak to you as well. But moving on, let's just quickly address the market strategy.